Germany releases their CPI data today. We're going to find out whether that data is going to scare the ECB into action. And the Israel-Palestine conflict's influence on markets is fading. We hope the influence of it fades in reality too, as in, they de-escalate and no more people die. But we're going to find out whether there's a different market path going on right now. And the trading takeout today is going to be nothing ever good happens under the 200 daily moving average. We're going to look at the context of that as well. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So 1 p.m. UK time, we have the German CPI preliminary. So this is the unrevised number. And the expectation is that it's going to come in at 4% bang on. The previous was 4.5%. And I'm going to show you a chart now. And this is quite important because it's going to display the trajectory that German inflation has been on. So you can see here the most recent print of 4.5% is down from the previous one on that at 6.1% roughly. And, the high back in November 2022 was 8.82% approximately. So we're seeing a real collapse in Germany in inflation and also in inflation expectations, because if we look at the expected number, it's at 4%. When the previous was 4.5%. So that's very, very disinflationary. Now, if we do get a miss here, we're closer than at any point previously to the ECB's target of 2%. What I would be very, very cautious of is now if they come out with hugely dovish rhetoric, because the way that would start looking is if we go then and look at the euro, where are we? Let's take the ICE feed. If we go then and look at the euro, we've got all of that space left to go. And later today, we've got the ECB, right, actually, as the German CPI comes out, we've got De Guindos speaking, who is a dove. So he's a dove. It's going to be a text release. And then we've got ECB's Enria, who's actually extremely crucial to the whole structure of the Eurozone, also speaking at the LSE. He doesn't, do anything in terms of the actual votes, I don't believe. He's on the supervisory committee. But he looks at things like, okay, where are the bad assets? Where are, risks in the banking sector according to the monetary policy, things like that. So if we're looking at, the way in which interest rates might affect the banking sector, it would be good cause for him to come out and say, well, actually, I think we might need them a bit lower now, even if inflation is still a little bit elevated. So I would be looking at weak euro through today, through the front part of the week, and then perhaps a little bit of alleviation in euro weakness towards the back end, because it is quite sold already. But I wouldn't be surprised if we do get below 1.05 through this week. I think that there's enough impetus if we do get a dovish print, so a under expected inflation print from Germany, because they're obviously key to the whole bloc. They drive a lot of the import export in the bloc, and any kind of dovishness from the German consumer means that there's a broader weakness across the whole bloc, in my view. So in terms of the conflict going on in Israel-Palestine, awful that it's occurring, but unfortunately we have to speak about it in a market context. And the market currently is pricing out any sort of risks, in my view, of escalation. If we look at gold, this is when we started to really, really rally off the back of it. So back here on the 7th, I believe. So this is when the rally started. We made a bottom, and then we really started to kick on, kind of got worse here. But the market, in our view, is pricing out the risk of full-blown war, the risk of, proxies coming in, not proxies, of other countries coming in, and there being proxy wars and things like that. And so what we're looking at currently is, okay, well, what is the added value of buying gold up here? If yields increase this week, then it makes gold less attractive. If the Bank of Japan turns less dovish, which is very, very likely, it causes the same. Aggregate yields globally increase. And if that fear of war is not really, really kicking off, it's easy to price out. So the risk to reward, in my view, is skewed to the downside on gold now. It's purely based off the fact that markets react off of escalation and de-escalation. The period for that signal of escalation to really kick the price of gold forward has decayed. It's gone. It's kind of, what we're seeing now is skirmishes, and we are seeing bombing and things like that, but it's not a full-blown invasion. I don't think anyone really actually wants that, despite what they may say. And I think a lot of pressure from the international community is on Israel specifically here. And so I think that it's going to just be this long drawn out story of, you hear about awful airstrikes and things like that. But not to the extent that people had priced in this moving gold effectively. So that's the position. I think if we're looking at gold from this perspective, it's touched 2000, big old psychological level. I can see people that are definitely still buying here. And I think that there's just enough sort of gas to push it lower here to really, really start spiking. Anything on good news should really kick people out of the market, in my view. So there's a very important chart here, and this is NASDAQ E-mini futures, and today's trading takeout is going to be why nothing good happens below the 200 daily moving average. And you don't even have to know the why, actually. You can just take that as gospel pretty much, because it's true. The context that would lead equities to trade underneath the 200 daily moving average means that things aren't going well. And currently, we can see here that tech, and the 2 days of last week, towards the end of last week, so Thursday, Friday, tech closed underneath the 200 daily moving average. It will be very, very interesting to see what happens today, whether we get a rally up here and break the high and maybe even find some support. So we trade sort of like this and go higher, or if we just capitulate. And I think that, nothing good happens under the 200 daily moving average in equities, purely because equities are designed really to go up. Indices are designed to go up. If, for example, a stock in the S&P 500 becomes of a smaller market cap than the one previous, it gets replaced. And so you're constantly seeing this replacement of a previously smaller stock that became bigger and overtook the other one. So that causes an index to go up over time. And that is really the main driving factor behind the belief that nothing good happens under the 200 daily moving average, because for equities to go down considerably, something has to be going wrong. And as a key trend following sort of tool or piece of technical analysis, the 200 daily moving average is perfect for identifying this. So just remember, nothing good happens under the 200 daily moving average. And if you do see a reason for it to go like this and then test it, you could probably look for some bad news. Look for some bad news and check and see if there's any downside available.